Imagine this. You work hard every day. You skip vacations, you avoid expensive restaurants. You save every extra dollar you can. And after 10 years, you finally check your savings account. Then, you realize something shocking. Your bank made far more money from your money than you did. In fact, your bank may not actually want you to become a great saver. Sounds crazy? After all, banks tell us to save money. They advertise savings accounts. They encourage responsible financial habits. But behind the marketing, there's a completely different business model. And once you understand how banks actually make money, you'll never look at your savings account the same way again. Millions of Americans believe that putting money into a savings account is the safest and smartest financial decision. But what if I told you that your bank isn't making money because you save? It's making money because you borrow. Today, we're going to uncover how banks really work and why your savings account isn't helping you as much as you think.
Let's start with a simple question. What happens when you deposit $10,000 into your bank account? Most people think the money just sits there, waiting for them to withdraw it whenever they want. But that's not what happens. The moment you deposit your money, the bank starts putting it to work. Banks don't store every dollar in giant vaults. Instead, they lend your money to other people. That money could become a mortgage, a car loan, a business loan, or a credit card balance. And here's where things get interesting. Your bank might pay you 0.5% interest on your savings account, but that same bank could charge someone else 20% interest on a credit card. Think about that. You provide the money, someone else borrows it, and the bank keeps most of the profit.
Let's compare two customers. Customer number 1 saves $20,000. Customer number 2 has a mortgage, a car loan, and 3 credit cards. Who do you think is more valuable to the bank? The answer is obvious. The borrower. Because debt generates recurring income. Every month, borrowers make payments, and a significant portion of those payments is interest. According to financial reports from major American banks, lending remains one of their biggest sources of revenue. The more people borrow, the more banks earn. Saving money is good for you, but debt is often better for the bank. And that's why you'll see credit card offers almost everywhere. Your mailbox, your email, your mobile apps, even while shopping online. Banks spend billions encouraging borrowing because that's where the profits are. Here's another uncomfortable truth. Even if your money stays in a savings account, inflation is quietly reducing its value. Let's say your savings account pays 1% interest, but inflation rises by 4%. At the end of the year, your bank balance is technically higher, but your purchasing power is lower. You have more dollars, but those dollars buy less. This is one of the biggest financial misconceptions in America. People think saving automatically makes them wealthier, but if inflation grows faster than your savings, you're actually losing money. Meanwhile, banks continue lending at much higher interest rates. So while your money grows slowly, the bank's money grows much faster.
Have you noticed something strange? Modern banking apps make borrowing incredibly easy. Need a credit card? Approved in minutes. Need a personal loan? Click a button. Need to split a payment? Buy now, pay later. Everything is designed to make spending feel painless. Psychologists have discovered that people spend more when they don't physically hand over cash, and banks understand this very well. The easier it becomes to borrow, the more people spend. The more people spend, the more debt they accumulate. And the more debt they accumulate, the more money banks make. This doesn't mean banks are evil. They're businesses, and businesses are designed to generate profits. Understanding that simple fact changes everything. So, should you stop using banks? Absolutely not. Banks provide essential services, but you should understand their incentives. Use savings accounts for emergency funds, not for long-term wealth building. Avoid unnecessary debt. Pay off high-interest credit cards. Learn how inflation works.
And most importantly, understand the difference between saving money and growing wealth, because they're not the same thing. Saving protects money. Investing grows money. And once you understand that difference, you stop thinking like a customer and you start thinking like an owner.
The next time you open your banking app, ask yourself one question. Who is making more money from your money? You or your bank? Because the answer to that question might completely change the way you think about saving, borrowing, and building wealth. If you enjoyed this video, subscribe for more videos that break down the hidden rules of money, banking, debt, and the economy. And remember, the financial system isn't always complicated. Sometimes it's just designed in a way most people never question.